Hello, Derek. Welcome and welcome to our listeners.
Hi, Shan. Yeah, good to be here. Good to talk.
Yeah, nice to have you here. We have a lot to unpack since last week's podcast. That's how it's been lately. Obvious place to start are the tariffs that we are expecting the announcement next week. So, what do you expect from them? How is the market positioned? And what are the market expectations going into the announcement? Obviously, a lot can change from now until then, but it'll be interesting to hear your thoughts on this.
Yeah, like obviously looking at the markets and in particular the way the markets have responded to the the auto tariffs this week. Certainly, like equity markets have come down. There's definitely a bit of a sense of risk off. I wouldn't say there's been a major move though. If you consider the auto tariffs are going to be added to and broadened out with the reciprocal tariff plan on Wednesday next week. So, you know, when you make assumptions on that as well, you have to conclude that the markets seem to be, in our view, still a little bit on the optimistic side. You know, I've been traveling a bit of late, speaking to clients, and a very common kind of comment made to me in my travel seeing clients is that Trump's a deal maker, he's a negotiator. These are all tools for leveraging to get good deals for the US. So there, quite often there was a sense that tariffs wouldn't last or they'd be watered down. And I'm not convinced on that. If you look at the US trade representative website, this process has been ongoing since it was announced, and we've had this kind of feedback period, which closed on the 11th of March. And, there's been an ongoing process. And certainly, the comments from Trump, I'll admit, have been mixed. And I think maybe the markets are taking some optimism from the comments that Trump made this week when he announced the auto tariffs, that the markets would be pleasantly surprised next week when he announces those tariffs. But, going back to the trade representative office, they've listed the countries that the US has the largest trade deficits with in the context of seeking feedback in relation specifically to those countries, or with emphasis on those countries. So it does look like the target or the approach, which wouldn't be a surprise because Trump has often complained about trade deficits. He calls them subsidies, which is, of course, ridiculous. But if that's the direction of travel in terms of, I think what's going to happen is we're going to have pretty broad-based, a large number of countries that are going to be tariffed. Maybe those 21 countries that were cited on the website in these feedback discussion periods. And if you want to take, the top 10 deficit countries, 6 of them are in Asia: China, Vietnam, Taiwan, Japan, South Korea, and India. 2 are in Europe: Germany and Ireland. And 2 are the USMCA countries, obviously, Canada and Mexico. And if you look at where the deficits have increased the most in 2024 relative to 2023, which could also be on Trump's radar, it's Taiwan. It's had a 50% increase in the deficit. Ireland, tiny Ireland, 33% increase, and South Korea, a 27% increase. So what I'm getting at is that there's a good risk, we think, that the Trump administration could be more harsh on those countries, maybe those 10 largest deficit countries, but there'll be broader tariffs beyond those countries as well. And if that's where we're going, then I feel maybe the markets have been a little bit overly optimistic. Now, we've done some quants analysis that's in the FX Weekly today, and it does show that the price action fades more quickly as we've had more tariff announcements. So the markets have become, I guess, less responsive to tariff policy developments. And that's, of course, because I think there's been a shift in investor expectations about the relative impact of tariffs. Because, of course, we've had the German fiscal stimulus, which helps to dilute some of that negative impact in Europe. We've had the policy announcements in China as well in terms of boosting consumption. And then, of course, we've had weakening economic data in the US. So the expectations of the relative impact of tariffs has changed, and it's become less dollar supportive. But yeah, I still think maybe not immediately. And it might be that the markets wait until we start to actually see the incoming data being impacted by the tariffs before you get bigger reactions. So I'm not totally convinced that we're going to get a big one-off reaction. I think there certainly will be some volatility next week, but I think still there's maybe a degree of optimism in terms of the impact of these tariffs that are coming on the economies outside of the US. So that argues that perhaps the dollar could recover somewhat. And again, as we've pointed out in the FX Weekly today, there's been nearly a 75% reduction in US dollar long positions amongst leveraged funds. So the capacity for building dollar longs back up is certainly there, and market positioning is a lot more neutral than it was. So that does give the scope for possibly some dollar recovery if they're more aggressive next week.
Thank you, Derek, for your thoughts. This is a nice segue into my next question. And let's just talk broadly about central bank policy expectations. And obviously, in light of the tariffs, the impact on the various economies, as well as the obvious inflation impact. What are your thoughts on what to expect from central bank policies?
Well, again, it's on this point that I would make the argument that maybe markets are being too optimistic about the tariff impacts globally. And like if I look across G10 and look at the implied terminal rates of policy rates for G10 central banks, and by that I mean, where do we stabilize in kind of 2-year OAS, 3-year OAS? And in largely, excluding Switzerland, Japan, and Sweden, largely you're talking there's a pricing of about another 50 basis points of rate cuts. Now, if you consider, for example, say the Bank of Canada, who have done scenario analysis on a 25% tariff on all Canadian goods imports into the US and retaliation of 25% as well. The Bank of Canada makes the assumption that there's a 2 percentage point hit to GDP in year one and a 1.5 percentage point hit in GDP in year two relative to the base case scenario of whatever GDP growth would be. And while there's an inflation impact, the Bank of Canada believes that in the first year, there wouldn't be much inflation because there'd be excess capacity, excess supply. And they're clear that they would respond to the GDP hit in terms of monetary policy. Take the ECB, they've done scenario analysis and they've made the assumption on a 25% tariff and retaliation that there'd be a 0.5 percentage point hit to GDP in the Eurozone. Of course, smaller than in Canada, but still notable enough to make the case that the ECB would surely be considering and acting to bring some monetary stimulus into its monetary setting. Now, the terminal rate for the Eurozone is pretty much, we're a little bit below 2% in the 1 year period, but then in 2 and 3 years, we've bounced back, partly because of the German fiscal stimulus, of course. But again, you've got to make, surely there's a strong case in a tariff scenario where the ECB could be having to consider cuts of greater magnitude than what's currently priced into the OAS market. And you could make the same case then for the UK, but maybe less so the UK because it may get away lighter than others. But certainly for Australia and some of the other European G10 countries as well. So in that sense, I think there's scope for rates potentially to come down. Maybe not immediately, but if you take a 2-3 month time horizon, and that could be part of the factor that maybe helps trigger some dollar recovery in the coming quarter.
Thank you, Derek. Okay, to wrap it up, the final question: what are your thoughts on the BOJ policy meeting summary and the outlook for the yen?
Yeah, the yen has weakened. It's come back today because U.S. Treasury yields are coming down on the back of the weak real consumer spending print, which reinforces the likely slowdown in GDP growth, sharp slowdown in Q1. So rates have come down, dollar yen has come down. But before today, the yen, it probably still is actually, but it's the weakest performing G10 currency this week. And going back to that, tariff theme, the BOJ, of course, is priced for 1.5 hikes. And of course, aggressive tariffs that hit growth, there's a higher chance that maybe the BOJ would have to hold off on its tightening cycle. And I think that encouraged some yen selling this week. Today, though, we had inflation data from Tokyo, much stronger than expected. So the core rate was at 2.2%. It was expected to be at 1.9. Importantly, we're starting to see rental inflation. Well, not starting to see it go up. It's still steadily increasing. I think it's 1.1% now. And rental prices, obviously a bit stickier, a bit more driven by wages, which is what the BOJ is looking at. And food prices are going up as well. So rice prices up between 80 and 90% on an annual basis. So it's still a cost of living crisis kind of theme for Japan. And I think the pressure is going to be pretty strong on the BOJ to still hike. Now, obviously, if there's a massive correction in equities, and I mean 15, 20%, and treasury yields collapse and dollar yen comes down over 5 big figures, yeah, they probably hold back. So I don't dismiss that risk, although I don't think that's what's going to happen to equity markets. But I would still say a reasonable scenario abroad, then you still get a BOJ rate hike. May seems unlikely. It's not very much priced. Our official call remains July. And it obviously depends how things play out in terms of the market's response to the tariffs. But at this point in time, we would still lean towards the BOJ hiking. So again, treasury market yields are important for dollar yen, but dollar yen over 150, I think is going to be a struggle to hold on to those levels. And we would certainly be a seller of dollar yen up at these levels.
Thank you, Derek. Thank you for your thoughts today. And all the best for next week. Same to your listeners. Until next time.
Thanks, Shan. Have a good weekend.
Thank you.
All right.